Hello and happy Wednesday. We're back for the second episode of On the Mark, Financial Literacy with Mark Zinman. So recently there's been a lot of buzz about the current volatility of the stock market, investor concerns, and some economic uncertainty. That's the topic that Mark's going to weigh in on today. Mark, let's just dive right in.
Thanks, Monica. Well, first of all, I listened to our first episode and I realized that I was a little remiss. We started this podcast, or planning for this podcast, months ago. And I wouldn't be anywhere without the team behind me. And the team that's in the room with me right now is my moderator, Monica, who I've known for many, many years, and Alicia, who's working the board and working the camera and doing whatever she can and holding up signs of encouragement every once in a while or telling me to slow down talking. So it's great to have those people, to help make this a better podcast. But yeah, the stock market. It's amazing how when it goes up, everybody's happy, and when it starts doing what it's doing now, everybody panics. So what is a panic? So every single person should have a financial plan. When I say a financial plan, I'm saying like an idea, like I want to invest in this portfolio, I got this advice, based on my age, based on when I need the money. And we'll talk about that in a minute, but basically you would have some type of a financial plan. So the bottom line is, no matter what happens, you stick to the financial plan. That's what I mean by don't panic. You don't change your buying habits. You don't sell everything. You don't run to safety. You hear on the news, the stock, people are running to safety. They're going from the stock market to bonds. Institutions do that stuff. They know exactly what they're doing. They don't ever lose money. But we're neither professional investors, nor do we have a significant amount of money to influence the market. And I will say that, and I want to talk about things like recession and stuff, but I will say that what's going on right now is very unique. Most of the times, the trend of the market is driven by fundamentals, like bad reports, jobs reports, high inflation, COVID. I mean, there's all kinds of things that we maybe know from life. This is being driven by words. Okay, and we're not going to be political here on the mark, but we're going to state what's going on. Okay, so we have an administration who comes out every day with something different. And the one thing, so I always say this about the stock market. The stock market is the most apolitical thing out there. It doesn't care who the president is. It doesn't care who judges are. It doesn't care who Congress is. It cares about making money. So it's unemotional. And it likes consistency. And what it doesn't like is uncertainty. And so we have a lot of uncertainty. We have uncertainty where we're going to have tariffs one day. They're not going to be tariffs the next day. We're going to exempt certain things. And you'll see that the market moves with these kind of commentary and whatever. The one thing that shouldn't change is what you're doing, right? What you're doing is you're planning for your future. And you should already be set up so that you are okay no matter what. Risk. So people talk about risk. Risk is time, okay? So when somebody says to you, hey, I heard that this stock is going to do amazing, and you go out and buy that stock, we call that gambling, okay? Because you're just gambling that, what was the GameStop was going to go up, or NVIDIA is going to be the most unbelievable, or Tesla is going to come, whatever your whisper down your line in your group is, that is gambling. You're basically gambling. You're not trying to go for a rate of return. You're trying to go for the lottery. Okay, so risk is time driven. So the more time you have, the less risk you have. So let's say, for example, you are going to take a family vacation to the beach, and it's going to cost you $10,000, and you have that money in the stock market. You may be in trouble because that money is needed by the summertime. This is already May. And you now are down from $5,000 to $4,000. When you have something that's that short term, you have to have it in some type of cash, something safe, a bond fund, a money market, whatever it might be. But if you're 25 years old and you're going to retire when you're 55 or 65, well, that's 40 years. Well, in 40 years, this all shakes out. And why do I know that? Because I've lived through these, what they call recessions, okay? And recessions is a word that's thrown around as being negative. And it is negative, but the problem with recessions is most times economists don't define a recession until it's over. So a recession is a historical how the market's done, And I just want to go over like I just want to just run quickly through, depending on their age of an audience, the last 3 recessions, right? So we had one in the end of the century called the dot-com, when people were, and this is again, people hitting a home run. They're investing in all these dot-coms. These are going to be the next best thing, whatever that dot-com was, and they suffered. They didn't turn out what they thought they were going to be. People were betting on earnings. They didn't get the earnings. People panicked, took their money out. We had a recession, and that basically, by definition, lasted from March of 2001 to November of 2001. Okay, and then we had what's called the Great Recession, which probably most of the audience remembers, which was the housing bubble. Okay, and again, I'm trying to differentiate. That housing bubble was a fundamental. It wasn't political. It was fundamental. We were overvaluing houses. There was a lot of people out there who were refinancing every couple of years and taking cash out. And what ended up happening is the values of the properties not only peaked, but they started to drop. So now we had people who had debt on property in excess of the value, and people, you may or may not remember, people were turning their mortgage, giving their house to the bank in lieu of foreclosure. They were doing all kinds of things, and that kind of thing really affected the market. And the last one we had was COVID related, right? COVID came, everybody was shut in, and that caused the shortest recession in history. And why did it cause the shortest recession in history? Because the government pumped $2.2 trillion into the, people remember the $600, the $1,400, the employment credit, all that money got pumped in, money to support local governments and whatever, and the United States government propped up the entire economy until we got through, okay? So time heals everything with the market. And I advise, so I have people come in and say, okay, I'm 70 years old, I want to retire, I guess I have to have all my money in the money market. No, well, what do you have? Well, I have $1 million in my retirement. And, we talk about people that are in retirement age. We talk about them not so much like I make $100,000. We talk about I need, $10,000 a month to live. Okay, and where does that come from? So the question is, if you have $1 million in retirement and you say need $5,000 a month out of your retirement to supplement your Social Security and your savings, your part-time earnings, well, $5,000 over $1 million is 5%. Well, you can get 5%. Or you could, it's probably a little lower now, on a CD. So basically that's the safest thing, right? So, and the other part of it is that if you're only going to use $5,000 a month and you're really not going to touch your principal, when are you going to get to the second $500,000? That's long term. So you don't automatically shift on your retirement date from stock to cash, okay? And, sticking to a plan, the most pure example of sticking to an investment plan is a 401k, and I'll explain why, okay? So every 2 weeks, every week, twice a month, once a month, you get paid, right? Your employer withholds whatever you told them to, and maybe they match it. And then they have their own internal thing of when they send the money in, okay? You might send it in the day of payroll, within a couple days of payroll. Most companies send it in pretty quickly. Well, it doesn't care what the president said. It doesn't care what the last economic report was. It just sends the money in every other Tuesday, okay? So every other Tuesday, regardless of your money gets put into your account, it gets swept into whatever your investment is, and it averages out. There's no emotion to that investment. But you deciding to sell everything is an emotion. It's a reaction to what's going on. And I said in the last episode, the definition of the bottom of a market is when the common investor can't take it anymore and just sells everything because they think the sky's falling. And media does a really big job of playing up these negatives. I think that we all can agree, regardless of what your media is, they tend to focus more on negative than positive because that tends to make the headlines, tends to get your attention when you hear it on the radio, TV, YouTube, wherever you get your news from. So it feeds into fear, and so you don't feed into the fear, and therefore you stick with it. Back to these examples. So the Great Recession was a good one. That was the last one we really had. So I believe, and I'm trying to remember, and I'm giving this more as an example off the top of my head. And I didn't do research, but I believe the market was 14,000 when that started in 10 or 11. And the market dropped every single day. It went from 14,000, 13,000, 12, 11, 10, 9, 8, 7. And people were calling me every day. Like, do I sell? And I've heard so many methodologies of how to invest that we are like, after the stock market goes up 3 days, you buy. After the stock market goes down 2 days, you buy. I have nobody who's ever made money on any of these theories, okay? But every day I had people, and trust me, you lose 50% of your money, you are in panic mode, okay? And you're talking people off and you're saying, don't worry about it, it'll all be fine. And why am I saying it's all going to be fine? Because if you look at any index, I'll take the Dow, which is, what they call like the granddaddy of all the indexes. Since 1960, so for most people alive, it has returned 7.2% over that period. And in any 10-year period, it never produced less than 6. Okay, and you say, okay, well, that doesn't sound that great, but that doesn't include dividends. Most of the larger companies pay dividends. So if you're getting a 4 or 5% dividend, then that 7 is 11. And yeah, that's more like 11, 12. It varies. I think it tends to average back. So like we've seen in certain recessions, like the .com one, it got up to like 12, 12 and a half historically, and then we had a break and it got back to the 10 or 11. It's the same thing. And the S&P returned 7.17% in that same period. And again, without dividends, and again, that might be closer to 11%. So, risk is solved by time. Okay, the more time you have, the less risk. So I implore everyone to, it talks about when you have a financial advisor. Most people can't really hire a financial advisor unless they have between like 100 and 250 to invest, because most of them, just speaking from the point of view of the financial advisor, they're usually compensated. Historically, they were compensated by receiving commissions. Most financial advisors nowadays are on a percentage. They'll charge, depending on what kind of account you have, it's between like, maybe if you have a lot of money, it might be 0.5%. If you're doing stocks, it might be 2 or 3%. But they're doing it as a percentage of your assets each quarter. And the paperwork involved to set somebody up is the same whether it's a $10,000 account or a $1 million account. So obviously, financial advisors are in to make money, so they have minimums, so 100 or 250. But you could get a financial advisor or a robo-advisor or group things from your 401k. You can get it from maybe a Vanguard or Fidelity. They offer to smaller investors some kind of a pool type of thing. And you can get it from, talk to people. A lot of times, if your parents have financial advisors, even if you don't have financial advisors, they'll talk to you because they handle your mom and dad's money. So I just think that you just really need to not listen to the noise and listen and just stick to your plan.
Mark, while on that topic, we have a question from a gentleman named Gary in New York. Gary asks, I'm thinking about buying some dividend-paying stock. If I buy $10,000 in the stock and the current dividend rate is 6.2%, what is my rate if the stock goes down by 10%? Does that mean my dividend goes down by 10% as well?
So this is a question I've heard many times, or a variation thereof. So just to go take a step back, there is a strategy. So there's different strategies, and financial advisors do this all the time. So I'm going to answer the question, and I'll get back to that. So the answer is that when you look up a stock on Yahoo or wherever you're getting your stock information, and it has some type of a summary of the stock, it'll say what the dividend rate is. The dividend's 3%, the dividend's 6.2 in this case. What that is it takes. So most stocks pay dividends quarterly. So if, let's say, they're paying $3, let's do this. They're paying $6.20. That's 620. That's 62%. $100, right? So say yes, they're paying $6.20 a year in the gentleman from New York's example. Okay. Where they got the 6.2% is they take $6.20 as the numerator, and the denominator is the current value, today's market price. So the $6.20 doesn't change unless the company either changes its dividend by lowering it or raising it. And if the price goes from, what was this example, $100, $10, what was the example? How much was the stock in this case?
Mark, it looks like Gary did not provide us with that value.
If it goes up to $12,000, you still get $6.20. If it goes down to $800, you get $6.20. So let's talk about, I just want to jump into some kind of investment philosophies, just overall generally. So there is a philosophy out there where So let's just talk about risk again, okay? The safest thing is an FDIC-insured money market or CD or a treasury bill note, whatever, all the different terms from the government. They are no risk. I mean, the whole government has to fail in order for you not to get paid, right? Because you either have FDIC insured or SIPC or some type of insurance there for your money. And nobody really has ever, I don't know that anybody's really lost any money on anything in many years. Even when we had some bank closings a few years ago, the Federal Reserve made everybody whole, even if their accounts were over the limit. So that's the safest. So the floor is whatever the safest is at any point in time. Okay, it was maybe a year or two ago, it was 0.5%. Right now it's like 4 or 5%. And the ceiling is whatever risk you want to take. So if you say, I want to make 15%, then you have to risk losing 15%. Mm-hmm. If you say, I want to make 10%, you have to risk. And I would say that most portfolios throughout over people's ages designed for like 6 to 10%. I'm using today's rates, like maybe 7 to 10%, where there's a mix of different things. But there are philosophies. So one of the philosophies has been to buy dividend-paying stocks that are paying dividend rates in excess of CD rates. So let's take that 6.2%. And there are stocks out there I can name: Pfizer, BP, AT&T, Verizon. You could do your own research, but they're all above what you could get in a CD. And so you would buy that for the cash flow, and then you don't worry about the principal. Because you're trying, so we get back to the older people, right? You're going to live on, you want $10,000 a month, you need $5,000 from somewhere else. If you put $1 million, and by the way, we don't put it in one thing, but you put $1 million in a stock that's paying 6.2%, you're going to get $6,200 every year, no matter what that stock's worth. If it were $1 million, $800, $1 million, $2 million, whatever, you're going to get $6,200. And that might be what's important to you. And if you start focusing on the cash flow instead of the everyday, the Dow, it's a different change of mind, right? Money is very emotional. There's a huge, I can't tell you how many times I have to explain to clients about taxes. And it's really funny because I am a star. I am amazing when you get a refund, and I suck when you owe money. And I really have nothing to do with it. And it reminds me of the old H&R Block commercial where they said, oh, we got Miss Jones $2,500 back. That's because Miss Jones paid $2,500 too much, right? Mm-hmm. But people, it's just the mentality of that. And so that permeates throughout everything regarding money, right? It's all your take and your vision of that. So there's other times where we talked about dividend stock. There's also what's called a registered investment advisor, which is somebody, and I know a lot of 401ks that use this. Our own 401k at Simon & Company does this, right? Basically, we have a professional, and they put together groups of mutual funds, and they basically take a risk tolerance, like how, if the market goes down 100 points, what are you doing? If the market goes up 100, and they start asking you intelligent questions to see, like, are you going to be watching the paper, or are you going to be calling them every day? And that, based on age, based on explanation, they'll pick a portfolio. And that's a blend of all kinds of mutual funds, and then they're responsible for adding and subtracting the mutual funds in that portfolio. And what does that really mean? So diversity is always key in investing. You don't want to put all your eggs in one basket. Same thing goes in investing. Well, you go out and you buy, Vanguard Wellington, Fidelity Magellan. I'm just throwing out names that are well. What do they own? Nobody knows. Mm-hmm. I mean, you could do your research and find out what they own, but that's what you hire that professional in a 401k administrator or your financial advisor to know, that a large cap fund could be Microsoft. Microsoft could also be a technology stock. It could be in different whatever they define as market sectors. So those people are putting together blends of different mutual funds, not only to get the desired spread, but also to get no concentration. Mm-hmm. And they usually charge a percentage of the assets. And a registered investment advisor is probably the cheapest one, because they're going to charge you, most of them charge like 1%. And then, depending on what the value of the whole household is, maybe there's a price break at 200 or 250, and then it goes backwards, because they have a sort of, like I said, there's a fixed cost to investing. So they're going to want somebody who's going to pay something. So the more money you have, the less they have to make you a profitable client.
Mark, thank you. And we have some dividend calculator tools on our website at onthemark.cpa. Please feel free to check them out. We also look forward to seeing you again next Wednesday when we provide Investor 101 tips for people just starting out. Yes?
Yes, that'd be great. I mean, we talked a little bit of investing here, and we talked about it when we did our first episode about different age groups. But yeah, I mean, these terminologies and things that we're saying, and again, I'm welcoming like the success of On the Mark is going to be based on two things. One is, obviously, if you like me or not. Hopefully everybody loves me. My mom loves me, but hopefully everybody loves me. But it's going to be whether you like it and whether you're going to take the time to either watch or listen to us. And I think that the questions that could be asked by our audience, and I'm just going to give an example. Prior to COVID, I used to do, and probably what fueled my desire to do this, is I used to do like these phone banks during tax season where we'd go to the local channel and there'd be 5 or 6 accounting professionals who would answer a hotline, and for an hour or two we'd answer it. And I was always amazed at the questions, not because I felt the questions were, not good questions. It's just that I felt that the level of understanding was less than I thought it was. And so people were asking like really good questions that I just took for granted. If you're good in your profession, whatever your profession is, you take for granted that the stuff you deal with every day, you just take for granted that everybody knows that because you deal with it every day. You can't do that in finances. And then again, financial literacy is knowing every single thing that goes into making decisions so you can make a decision based upon the facts and take your risk as an informed risk, as opposed to that's the way it is, or being a victim of your decision instead of the person who commands their decision. So yeah, I'm really looking forward to having that conversation with everybody.
We thank you for joining us for today's episode of On the Mark Financial Literacy with Mark Zinman. See you next week. As evidence of how quickly the stock market changes, please continue listening for bonus content. Mark, I understand you want to share some updates regarding the stock market.
It's very hard to do these podcasts and be as do the editing, get them out timely before things. But the thing I want to notice to everybody is in the last few days, the tariffs have changed, and all of a sudden the market went up. And if you look at the 3 major indexes, the New York Stock Exchange, the S&P 500, and the NASDAQ, all of them are within 5% of their highs now, as of this morning. So I bring that to our attention of our audience because I said, don't panic. That was my immediate thing. This is why you don't panic. And we're in a very short term here. Now, 90 days can come and things can change, but this is why when you invest, your risk has to be based upon time horizon. So if you need the money next week, you can't invest. But if you need the money for your retirement in 10 years, this should not be worrying you at all about sticking with it. So anyway, let's hope that by the time I do episode 4 or 5, we can say we're up, okay?
All content provided on this podcast is for informational purposes only. No representations are made as to the accuracy or completeness of information that is presented. On the Mark, its owners, collaborators, and guests will not be liable for any errors or omissions, nor for any losses, injuries, or damages from the use of this information.